Good afternoon, everybody. Welcome back to the Schwab YouTube Coaching Channel. Our next topic is long options, and I'm your host, Kevin Horner. Thank you all for being here today. Sometimes traders are looking for ways to take advantage of maneuvers in the market that may happen in a defined window of time, and also spending perhaps a little fewer dollars than they otherwise would to own the underlying stock. And we'll talk a little bit today about some of these ideas and concepts as they are associated with long options, both on calls and puts. Today we'll probably lean a little heavier into calls based on some of the opportunities that came across this morning. But we are going to talk around some theory, some strategy, and a couple of the Greeks along the way. So say hey to James Boyd in the chat this morning. He'll get to comments and questions I'm unable to. It's odd that JB and I are working together but not hosting together. So please remember that everything we cover for you today should be considered informational and educational only. We're not making any recommendations here, and we're not nor any endorsements for a specific approach to trading. What we're trying to offer you, though, are concepts and strategies that some traders may choose to utilize themselves. If you're doing so, that's great. Make sure that you're customizing these strategies and concepts to your process. It's very important that everything you take away from our education is really helping you to build a process that works for you. We recognize that the specifics behind these processes aren't going to work for everyone. We want you to hone in on a process and then customize it to the manner that fits for your tolerance for risk, the amount of dollars you put on the table, and so forth. All of that's very, very important. Now, of course, it's also important to know that options carry a higher level of risk. They're certainly not appropriate or suitable for all traders and investors. In order to trade options at Schwab, you do need to be approved to do so, and there are various levels of authority available to you. Make sure you're going through the requisite steps there, but prior to any trading, of course. Now, we will also incorporate technical analysis today to help us out a little bit. Very standardized levels of technical analysis, I'd suggest, because we are going to be leaning into really just trend evaluation more so than anything else. Trends, support, resistance, that kind of stuff as we're looking for our opportunities. So keep in mind that technical analysis is just one of our decision-making puzzle pieces, not the entirety of it. And so we remind you not to make decisions exclusively from what you get in the way of technical analysis. And as I mentioned, a little bit of an agenda drill down here. We will discuss long options and some of the concepts around utilizing long options. We'll discuss price time volatility and some examples. So I've got a number of symbols to look for today that I think are going to be pertinent for us. And I hope to place a few of those example trades within the portfolio today. All right, so taking a look at the S&P 500, what we seem to have is a bit of a pause to the rally that began last Monday, more or less. You'll see that we broke out from this continuation triangle. We broke it to the upside, and if you're the trader who was waiting for some sort of validation of the trend, well, you really got it when we broke the uptrend line right here. And that was, for a lot of traders, that first initial step to believing that we could have a breakout. And since then, yeah, we have run ourselves into some resistance up here. So you'll notice that we've not really traded much above this ledge. So we do have this flag kind of developing in here, don't we, over the last week. A little bit of weakness today, off 0.25%, but ultimately hanging out pretty well in the SPX. And we'll look for groups in the S&P that could be considered leading us. I'll show you those here momentarily. We'll notice also that we've had a bounce back in the NASDAQ, and the NASDAQ's also taking a bit of a breather here. So we've got ourselves back up above the 50-day moving average. We've been above it for more or less all of the last 6 sessions, with one that was very much on the line, right? Our close here was 29,373, and our 50-day this day was 29,374. So technically we missed it by a point, but the majority of the last 6 sessions have been above the 50-day and we've kind of held this range, right? And so for a lot of NASDAQ specific traders, they're watching this 29,100 level. Under that, they might get a little defensive. They might be uncomfortable. Perhaps they manage risk by reducing position size. Some traders, though, would say, you know what? I'm not even worried about it under that low because we've got the 20-day right beneath us, and they might just feel more comfortable managing risk with the 20-day moving average rather than the 50-day. Depends on your process, depends on your comfort, your tolerance for risk. All of those things play into how you manage your trend. But ultimately, we are seeing a beautiful uptrend in the S&P 500 that's in pause mode at the moment. And while we've not made new highs in the NDX like we have in the SPX, we at least are back above the 50-day and have taken out some of the range we were trading in previously. So some traders are suggesting that the NDX, due to its allocation heavily on technology, has improved sufficiently to validate at least some entrance into NASDAQ 100 securities, possibly back into technology. Now, interestingly, technology won't be one of the sectors we look at today because we are trying to lean a little more into the ones that are showing significantly obvious trends. That's one of the reminders I offer you as it relates to technical analysis. You know, there's a lot of charts out there for us. We don't have to work with the ones that aren't speaking to us. Often a trader will get bogged down trading what we're most comfortable with or what we've been trading the most. Sometimes it can be hard to get off of those groups, off of those stocks that were working at one time, even when they're not working, you know. So NASDAQ and technology has been under pressure outside of the last week plus. So for some traders, they've just ignored tech. And for those of you that have not ignored tech, you know, I'd encourage you to ask, hey, have you been doing well working with technology of late? If you're finding that the technology trends have been difficult to manage and not as helpful for you, well, then maybe that's a group to kind of put to the sideline until it starts to act better for us in the near term. So let's look at our small caps here, which have been very resilient. This also has the apparent makeup of a bull flag after having broken our diagonal downtrend line here, made a higher low right here relative to the last lows, of course, back here, and then right, I'll snap that line for us. There we go. And then more lows back here. So we've seen continually that the Russell 2000 continues to be just super strong. We like it, although it confounds me a little bit. I'm not sure how the market digests this the way it does. And yet I'm not going to argue with it because the price values, the price movement is what matters more to me than anything else. But we continue to see risk factors associated with higher yields and the potential for rate hikes, and yet the Russell 2000 just digesting all of those narratives that should play negatively into small caps, and they're just not. And so what are we looking for in the Russell? Well, we'd like to get a close over the high we've made here over the last week plus. A break to the upside would validate a bull flag, of course, and then we could look for more upside potentially. It might be as simple as just drawing the height of that flagpole in and then snapping that line, activating that line, and then adding it. You can always add it to as some traders will do. As a reminder about process, they might add that measured move calculation. That's essentially what this white line that I just drew in is. They might add it to the bottom of the flagpole. They might add it to the top of the flagpole, or you might do it both ways. You know, and I like the idea for some traders who take this approach and say, well, that's great. Instead of setting one target, they'll set two targets or three targets and layer their exit strategies at various points so that they're selling into strength and taking a little bit off as the move occurs. There's nothing wrong with that either. It's a process. As I've stated, it's important that we as traders trade to what works for us. All right, so what we're learning today, we've got upside available in the S&P 500 if we can break that bull flag bullishly, of course. We've got the same in the Russell 2000. And we may actually have more upside in the NASDAQ 100 if it can maintain its optimism here. We are going to hear from a few tech stocks in the afternoon today that could kind of give us catalysts going forward for the remainder of the week. It's been kind of quiet Monday, Tuesday thus far. So we'll see how the rest of the week will shape out. Now, let's look at our leadership positions. We're only going to look at 4 of the 11 sectors, and that's because I've already kind of evaluated which of these are in uptrends at this point. So while we're talking long options, like I've mentioned, today is probably going to lean heavier into call options, but remember that it's not exclusive to long options are not exclusive to calls. We can obviously consider risk or downside trades as well. The process for the conversation around calls is going to be the same as it is on puts. So when we're starting to talk about things like the use of the delta as it relates to the price of an option, I'm going to expand on that a little bit. And I just want you to recognize that what we talk about with calls can be applied to puts similarly. So now I wanted to lead with a look at energy, which is certainly showing some strength, right? We've seen oil bouncing a little bit, and many traders are going to say that, the risk of energy at this moment is the headline, right? That something gets done. And while the headline risk continues to be relatively negative for us broadly, the idea that maybe nothing is getting done in the Middle East, then we're apt to see prices running higher in oil. And if we see higher oil, then we may very well see continuation of what we've gotten out of the energy space. You'll notice we had a broken down trend line, and then we built in a little bit of a bull flag right through here, didn't we? And that bull flag has now broken to the upside. We're basically at a level that we have achieved a few different times over the last few months, aren't we? So if a trader were of the belief that energy were due for more upside from here, this could be an area to consider. So a couple of thoughts when considering a trading space. Remember, we want to be working in groups that are already in the midst of uptrends, and I think we could suggest as much here with the energy space because we've got a short-term moving average, that being the orange 20-day, crossing the 50 to the upside. You'll notice that we've tested the 20-day a couple of times. We broke it here in early July, and then we tested it right here again 2 days later, moved off of that to new short-term highs, built that bull flag, rallied into resistance. So essentially holding the 20 period here means that we are in a short-term uptrend. Could we be at a location for a pause up here? Absolutely, we sure could, right? So what I was looking for were stocks in this space that could very well be ready to make a move consistent with the space, or whose chart doesn't quite look maybe like it's already developed that. So let me show you what I'm talking about. I'm going to launch a watch list here. Let me link everything up so that my symbols will carry for me cleanly. I'm going to use one that is just uptrending all time frames energy. What that means for us, everybody, is there's stocks trading above all 3 of the major moving indices that are, moving averages that I work with: the 20-day, the 50-day, and the 200-day. Not necessarily the so-called right moving averages, but ones that are very commonly referenced and utilized by many traders. Now, a couple of interesting things here. Look at MPC as an example. Marathon made a fantastic breakout here, didn't it? But a lot of traders will look at this and say, yeah, that one's already feels like I need to look for something that's not yet broken that bull flag, right? Excellent move, short-term pullback, deeper than the 20-day, and then a slingshot maneuver. This thing is up 15% in 3 days. Now, from a long option standpoint, that might not be bad for some traders, but they're going to likely feel like they maybe have missed out by not having placed such a trade yesterday or even the day prior. And yesterday would have been kind of one of those cleaner days for consideration because we had a trade where we opened above the high of this day. This was our low day in the pullback. So yesterday, for the majority of the day, we felt very confidently we could get a hold move. And that could have been an excellent validation for a trader to maybe step into a long call position. At this time, it doesn't mean it's terrible by any stretch. Obviously, new highs in a 52-week basis are not bearish. In fact, as Zink is pointing out, we're not yet into the RSI 70 line, but we're getting close. So that would be confirmatory of the trend as well. If a trader were leaning into calls in MPC here, well, then maybe the key component would be to give it as much time as they can afford, right? You don't necessarily want to look for options that are going to be expiring this week or even next week. Perhaps the trader wants to give this something in the neighborhood of 28 to 42 days in window so that you could participate in what could amount to a 1 week, 2 week pullback or pause in the trend and still get something from an upside move were it to play out that way. So the other alternative at this point, of course, as it relates to a stock that's moved like this already, is maybe you just sit on your hands a little bit, expecting things to settle, right? Expecting a little bit of a consolidation sideways slash pullback to the 20-day once more. And some of you traders, that's exactly how you will process and build your watch list is, all right, this one's broken to new highs. It's not, now that means that validates the trend, but now for me to enter on an option, I've got to find an entrance point that's going to look more comfortable for me. So let's talk about a position that might look a little more comfortable. I'm going to scroll down. By the way, there's a number of these in this watch list that just look stellar all of a sudden. I mean, Phillips, same thing, right? Same obvious, bull flag over about 2.5 to 3 weeks. Holding support, beautiful. Valero, something similar. Now here's one that's actually just breaking out today. So this could be potentially one where a trader says, you know what? I might have a trade for this week or next week based on this breaking out after having consolidated briefly. In fact, if we wanted, we could look at Valero and just talk about the potential for the range breakout to be validating. So we've got 293 approximately, and then our high up here, if we take that into account, those prior highs, 319, I mean, that's a wonderful range, right? About 25 plus points, right? So if you're a trader who might be thinking about Valero and the potential measured move over the next month that could amount to 25 points from the breakout, you might be thinking about it getting up to the neighborhood of 345 to maybe 350. All right. In fact, let's just talk about this. Since we're looking at it, we don't have any problem with that. Let's talk about Valero and let's look at some of the options. So one of those key thoughts was let's give it an ample amount of time if it's in fact breaking out. So we have a $25+ range. Let's look at the long options that'll go out a little further than say, well, we could go to either the 21st of August or the 28th, probably right in the time frame consistent with this potential move. Notice as I'm looking over here for the implied volatility, I'm just seeing if there's anything that stands out as being more costly to us. Certainly the current week implied volatility is a bit higher, but the little further out we go, we're going to find that the options are not going to be terribly juiced. So that's not a bad thing for the long option buyer. Remember, when implied volatility is elevated, we're probably paying more for our contracts than we ultimately would with an average volatility. And this volatility window right now for Valero is pretty relaxed. And that's, of course, because we just had earnings 2 weeks ago. So now that we are 2 weeks down the road and at least 9 or 10 weeks out from our next earnings, in the near term, we're not going to be paying exorbitant values, if you will, for our options in Valero. Now, not everybody's comfortable with that, right? Because some of you want that volatility factor playing into things. But let's talk about what we might be looking at. So we've got 320 as our upside we're breaking through, and 293 is our downside. Like I said, about 25 points. So let's go to the window here. We're going to evaluate we're going to keep it kind of tight. So 14 strike prices. I'm going to also drop my menu here to select my columns. I've got them called Kevs. And what that incorporates for me are the columns that matter to me in selecting long or short options. And I pay a close attention to, I try to at least, pay attention to the open interest and volume where I can. And I also pay attention to delta. So let's talk about delta. I'll remind you that delta here is a two calculation measure. Delta can tell us the ratio of a $1 move in the underlying stock versus that move in the contract. So as an example, we are looking at the 305 here. We're going to get 74 cents on the dollar for any $1 move in Valero. So you're going to, if it goes up a buck, if Valero goes up a buck, this contract valued, pretty widespread, 2120 by 2460 would go up about 73 or $74 on a $1 move in Valero. So the other calculation for verification here is that the likelihood of that strike price being in the money at expiration. Okay, so 17 days to expiration, 73% likelihood of being in the money on expiration Friday. That's two good ways of thinking about delta. Now, how do we apply delta to thinking about the underlying stock and the option contract we're going with? Well, a lot of new traders, this is very common, they don't look at deep delta because the cost is exorbitant relative to what it would be for a speculative step. So we're trading at 323, 322 and a half. We are in the money on the 320s, right? But the delta is basically 50-50. 50-50 chance of being in the money at expiration. And not everybody likes that lower delta. Many of you would say, well, Kevin, you said if it breaks 320, I could move 25 to the upside. Why wouldn't I consider the 345 contract and trade for that? Well, a couple of reasons why. Number one is that 345 might be the ultimate move it makes based on that measured move calculation. And again, there's no guarantee of a measured move calculation working in our favor. So one thought is it might not even get there. Number two is, what if it gets to 345, but it does it the day before expiration? How much value is going to be left in a contract where we are afforded, we, the long holder of a contract, we have the opportunity to exercise our contract and buy stock in the open market at the contract strike price. In this case, in a wordy example at buying stock at 345, if it's trading under 345, why would we want to exercise it? We wouldn't, and we wouldn't have much value remaining either. So part of this process is doing the math, setting targets, and then working backwards and saying, well, if it does in fact get to where I think it can go, then how much can I expect from the contract? So I like, giving thought to that. If we think it can get to 345, should we maybe look at the 335, which could possibly be 10 points in the money, or maybe the 330, which could be 15 points in the money if it achieved the level I was thinking of. So many times a trader is going to say, I want that cheaper cost. But the cheaper cost comes with a lower delta, and a lower delta means a lesser probability of it being in the money at expiration, right? And so if it's a lesser probability of being in the money at expiration, that means a lesser opportunity for the long option trader to be profitable. Okay. And that's something that I think many new option traders are uncomfortable with. They are unwilling to spend more for a greater likelihood of profit. They would rather spend less for a lesser likelihood of profit, even though it may not play out their way. And I think if you're a trader who is bogged down by this idea, well, then maybe what you need to do is start scouring for positions where the opportunity for your trade is much less costly than something like we're seeing with Valero here. 2 weeks out does add some time and add cost to it, of course. So this is a delicate balance for many traders, especially for the new trader trying to get comfortable with buying options. Really, the best well, I should say the best, the thing that I grew most comfortable with regard to long options is the idea that I can't lose more than what I put on the table, but I should at least be comfortable with what I am putting on the table. So looking at Valero, if I am uncomfortable losing $1,000, I probably shouldn't consider that 325 strike price, right? Now I could use and incorporate stop orders or decide to sell if it erodes my profit by 50, my investment, that is, by 50%. I could do that. You can certainly take that approach, but that's not one that everyone wants to utilize. So a number of ways to go about your process. Let us consider the speculative strategy that has us buying a slightly out the money contract at 325 and what that looks like in the way of cost to us. So here we are again, we're basically a 50-50 contract. We'd feel a little bit better if the spread was slightly tighter. We don't have quite as much volume today as I would have hoped, but 50 cents between, so 1030, 1130 probably means we can be a buyer in the neighborhood of 1075 or 1080 here. So we'll place that with a left click here, and that'll get us just the one contract. There we go, one. And then there's our limit. And so like I said, I'm going to go in at 10, see if I can get us in at 1075. That's just a nickel under the midpoint, basically making the market maker come to us just for a nickel of difference here. See, so there's the mid at 1080. Okay, so it's moved a little bit, 1040 by 1130. So the mid is 1085. Let's see if we can get in at 1075. And then we're going to look at what that means for us. So 1075 from the 325. By the way, it's always helpful to check your break evens. That means we really need to see this above 336 to get to a profitable scenario, right? So keep that in mind. So we're going to be buying just one contract, 325 strike, cost not to exceed 1075. Our break even would be 335.75. Total outlay $1,075. And let's see how that looks. All right, so here in paper money, the market maker came to us. Not a surprise. We'll often get execution in paper money, even if we go in below the midpoint. Recognize that that's not always going to be the option for us in a live money environment. Please bear that in mind. Now, let us look at where the break even would be. I mentioned it at what do we say we bought for 11? So we said 335.75. And one of the things that I might do is snap this line at that next level. So I duplicate the line and then edit it, and then just put it in here, 335.75, 335.75. And now I've got that line up here, and then I might just say, all right, this is my break even. This way I can pay attention to it. There we go. All right, so then I can watch that, and then as price goes through that level, I'm going to feel a lot more confident that I've got a winning trade on, right? And the speed of the move, if Valero gets to the break-even point quickly, we're going to be afforded the chance to be sellers. In fact, if we take a look here, let's change this to the theoretical pricing, and let's just say we suggest today's the 11th. Let's go forward a day, tomorrow. we go up 10 points in Valero. Let's just say, oops, there we go. So approximately, 332.5 from where we are. If we picked up 10 points tomorrow, look at how nice that contract increases. You see that theoretical price here? 1582 becomes the approximate theoretical price. Reminder, that's like the mid. That is not the bid or the ask, but that's kind of what we could expect. And what some traders will do here, everybody, is they'll calculate a potential move, add that into the Theo pricer, and then just say, all right, if it gets there within a day or two, that approximate value, that'd be great. Maybe the trader just goes ahead and says, boy, if we can get to that, I'll go ahead and sell it. So maybe they're in here and they're just placing a good till canceled limit to sell at 16 from the entrance at 1075, about a 50% return. And they could go that way. For the same opportunity, though, everybody, don't forget, you don't have to go that way. You could also do it with a closing trade. Let's go from our monitor page here. So you right click in here and you can create the closing order. And rather than a limit at 16, we can create it as a stop exit as well. Okay, so you could choose to go either direction with that. Again, I'm going to encourage you to give thought to the idea that if you're speculating with options, then the amount of money you put on the trade might be going to zero at some point, right? That is an absolute risk with long options. And some traders take the approach, just says, yeah, if it goes to zero, then so be it. Or when I placed the trade, my belief was that it could go to zero, and therefore I'm going to give it the opportunity to go in my favor the entire window of the options series, the contract's life. So however you choose to do that, set that strategy for yourself and then try to adhere to it as best you can. All right, let's see what we got here. So yeah, Sam, I'm going to mention Sam's mentioning the potential of buying an in the money call, selling an in the money call above the long side. You're talking about a long spread, a long call vertical spread, which you can do, of course. That's going to help you reduce your cost. Anytime you spread off a long option, with a short option above it, you cut your upside target opportunity, so you are limiting profit, but you're also reducing risk. So not a terrible approach, and maybe a deeper dive into some of the long vertical option opportunities here on the channel could prove to be helpful. There's definitely some other interesting areas here beyond just energy. So give me a quick second here. I wanted to show at least one other stock from an example standpoint today. This one, let's go into let's go to healthcare. So in here in healthcare, it's the same approach, but look at Gilead, everybody. Check this out. We've got a group that's been doing well. So healthcare has been running for us. There's no, that's financials. There's healthcare. So healthcare, nice uptrend, right? 20-day moving average has been supportive and recently broke out. In fact, broke out today, traded to new highs. Did not hold at this point, but maybe that's considered opportunity. Why Gilead made the chart for me, or made the list for me, was all of this action. We're basically at a potential resistance point after having broken the obvious and beautiful downtrend channel, right? So if you drove the channel through here, you could do it, right? Through these recent lows, like so. You could also choose to draw it and capture this high here. Either way, what stands out to me is that it's held this range. So we've got, yet again, another range, about, in this instance, about 10 points, right? And we're looking for the potential to break out. And maybe that means that the trader is unsure of the break because we haven't closed to new highs. We've traded as high as we have now for the last 3.5 months. But we have evidence that that healthcare as a collective group is moving. So perhaps Gilead will move higher as well. And if you're the trader who is wanting to believe that a breakout is coming rather than allowing a breakout to come and then buying in, you could buy in advance and give yourself not just time, but price down to support. And this is where some traders like the idea of instead of buying those higher levels, right? So instead of buying a 137 or 140 call, they might say, because we're not breaking out yet and it's not clear for me, my option is to A, sit on my hands, wait for the breakout, know the price of the contract I want to work with, and then buy that contract only when it breaks. That is absolutely worthwhile approach, everybody, because the likelihood of the breakout increases on a close over 137.50. And if you're waiting for a close over 137.50, then you may have probabilities on your side by being patient. By the same token, the trader who says, I don't have the time, I can't monitor this live and in the moment, I'm building a trade based on a belief that a breakout's coming, then the trader might fall into the belief that as long as we maintain these recent lows, notice the 50-day is just shy of 130, maybe the trader's comfortable over 130. And this is where perhaps in the money contract can make some sense. So let's look briefly, because we're running up on time. I can't believe how quick these sessions go. But let's look at these IV levels, right? We have a higher IV for this week, a higher IV for the following week, but 2.5 weeks out, the IV starts to really kind of pull back a little bit. Our lowest IV goes all the way out to September. So that's kind of interesting. Let's go out to the 31 days out from today, and let's just look at those 130s. Now, see, this is what I don't like to see, unfortunately. That spread is massive. And why is that? Well, let's go to my drop down here and select my list. Look at how there's just no volume. So as good as that looks, there's just not volume. Even here, where I have volume today at the 135 strike, which makes sense given our price action here, I've got a spread that's still $1 apart and only 18 contracts of open interest, as many as 30 at the conclusion today. That doesn't necessarily feel as good. So maybe we go back a week and you start to see where are we having more contracts. So back a week, you got the 130s, still not tight enough. 130s, still not tight enough. Man, I've got all kinds of open interest, but I just can't justify the spreads here, you know? And the reminder I've got to give us when we're looking at these, everyone, is that our friend Ben Watson says this all the time. You know, Ben and I do these our in-person events together, and he's reminding viewers and attendees frequently, look, when we're trading long options in particular, we want to be a small fish in a big pond. We want to be one of the 1,100 open contracts at 130, not one of the 11 contracts at a same price, right? So interestingly, only 10 days out, this August contract looks far more appropriate than going out the extra 2 or 3 weeks. And so if I was to speculate, this might be the area to speculate. This might be one to consider. And notice, by the way, look at that high, super high delta. Some of you would say, Kevin, that's way too high. I'm not going to pay for that likelihood of value in the money. But ultimately, this would be a potential one where you'd walk away saying, yeah, I might spend $725 to own this contract. What does that look like? If I'm buyer at $725, my break even is $137.25, right? That's my net cost. And if it's simply at resistance and doesn't break, there's a good chance that I'm going to be walking away with some value remaining. As long as it's over 130, you know, on expiration Friday, there is likely to be some value left. So that's why some traders would consider that. And I know I'm seeing it there. September 18 is the date that you liked, George. You know what? I kind of like it better, but I'll tell you what, when I'm looking, I would prefer the time, but when I look at those spreads, they just don't make nearly as much sense. So, you know, I'm not going to place an example trade on the Gilead here because mainly because we won't have an opportunity to follow up since I'm picking up this class on a one-off basis for Connie, but I think it's notable that the this spread has tightened up by going forward in time, right? By coming 2 weeks earlier. And I do think it's important for consideration that you're looking at the bid and the offer, looking for tight spreads, and looking for higher levels of open interest and volume. As you can see, if I was going to default to exclusively open interest and volume, you can see, look at how tight that 135 spread is. That is tied to the fact that there's this much open interest today and this much volume today. All right, we're going to double or come close to doubling open interest at the close today. And look how tight that spread is as a result. And some of you might say, yeah, that makes a little more sense. You might be more comfortable buying the at the money contract or slightly in the money contract for the potential of a breakout. And you would not be alone in that viewpoint here, evidenced by today's volume. That would be my takeaway. So, all right, everybody, it looks like we're just about at time. I do see we had a survey make it to the chat today. Always appreciate hearing from you. I do not get to do many option series for you all, so I'd love your feedback. Feel free to make any comments. Those notes that you make come directly to us as coaches, so it takes all of 60 seconds there. You can click that link. It opens in a new browser window right next to this one, and I would value your comments and ideas, everybody. Additionally, remember to make sure you're subscribed to the YouTube channel. We call that Trader Talks, and if this was in any way helpful for you, the thumbs up down below will help us out. We get this reviewed by our compliance team. It gets into the archive for archive viewing, and that thumbs up helps YouTube to realize that there are people out here who got something from this class and it wants to show it to more individuals so we can make it to more viewers. So with that, thanks to JB there in the chat. Hit that survey. Follow us on X, James Boyd CS and Kevin Horner CS, and a big thanks to our production team as always. I'll be back a little later, back for the 4 p.m. building a stock portfolio class where we will do a little analysis on the closing markets today and a look at our example portfolio. So for those of you awaiting that class, I will see you at 4 Eastern. Have a good afternoon, everybody.